Recovery continues following the mid-December wildfires in Kansas, which resulted in loss of livestock for some. Producers are now looking to the Livestock Indemnity Program, which compensates owners for unexpected deaths caused by adverse weather. Roger McEowen with the Washburn School of Law joins us now to review some of the associated tax reporting issues when LIP payments are received. Roger, good to have you with us today. Let's start with some background on the LIP program and how it works.
Well, Tammy, good to be with you. It is administered by USDA's Farm Service Agency. It was created under the 2014 Farm Bill. It was amended in 2018 to bring in contract producers of poultry and livestock. And so if you have experienced excess mortality caused by adverse weather and other events such as attacks by animals that have been reintroduced into the wild, as well as death by certain diseases, then the LIP program may be there to help you get through the problems that you have.
So what are some of the main eligibility requirements?
Well, the first thing I would point out is any producer that makes an application for LIP payments has to have sufficient evidence of an eligible cause of loss that was a direct cause of the loss or death. And if you're a contract grower, then you also have to show the USDA your contract. You have to be able to produce your contract and show them what that says. But you must have suffered a death loss that exceeded normal mortality rate and by virtue of an eligible loss condition. And that's an adverse weather event that was extreme and was not expected during the loss period in which it actually occurred. And that can be fire. Fire is one of those events. An eligible disease might also be an eligible loss event, as well as I said earlier, an attack by animals that have been reintroduced into the wild by the federal government. We see that one further out west in the U.S. And again, you either lose the animals by death or they're injured so badly that you had to sell them. Other than a contract grower, you sold them at less than market value, and so you can get compensated for that loss.
Are there any tax reporting issues that can arise with these payments?
There are several, but let me pick one. And it's a distinction between breeding livestock and non-breeding livestock. If you lost breeding livestock, if you were to have sold those livestock, say they weren't damaged in a fire such as happened in Kansas, when you sell your breeding livestock, that goes on Form 4797. Those are what we call 1231 assets, and they're not subject to self-employment tax. Other livestock are. And the problem that producers can run into is that they're going to get a Form 1099-G from USDA, and that's an information return, and it's just going to lump the entire payment together. And IRS is going to look for that on the government program payment line on Schedule F, line 4A. And what I'm saying here is if you lost breeding livestock, there's no need to be paying self-employment tax on that. And so they need to get with their practitioners that are filing the returns for them and separate that out so that you don't have to pay self-employment tax unnecessarily. I'd say that's the big tax issue that's out there.
Sounds like it. That is Roger McEowen with the Washburn School of Law. We appreciate your time and information today. That's good advice.